Good morning and welcome back to this week's Manager's Thoughts. This is Kelly coming from Synergy Asset Management. Today is January 13th, 2023, and we're super excited to give you guys just a brief update of what's going on this week. Alrighty, so just get right into a quick market update of where we are in the market so far this year. January, as you've probably noticed, has continued to be a positive month as we close out this second week of the new year, and so the largest catalyst or risk we've kind of seen so far this year was the CPI data that came out on Thursday. That came in just in line with expectations, so equity markets weren't super surprised by it, didn't move too much. And as of close on Thursday, the S&P was up 3.7% year to date, the NASDAQ was up about 5.1% year to date, and the Dow Jones Industrial Average was up about 3.4% year to date. And also the 10-year U.S. Treasury yield has already fallen about 6.6% year to date. So definitely interesting moves, and we'll continue to monitoring these markets to see if it continues to move positive or negative in the new year. So moving right into the big December CPI report that we got this week on Thursday morning, headline CPI came in at 6.5% year-over-year price growth, and core CPI came in at plus 5.7%. So both of which were exactly on par with expectations, and so also on a month-to-month basis, this was a negative 0.1% CPI reading and a core CPI reading of plus 0.3% on a month-over-month basis. So markets were not really surprised by this data to the up or downside, so that left the S&P up just about 0.3% on Thursday in reaction to the news. Also, I just wanted to note in this chart here, you can see that since that high of 9% inflation in June of 2022, it really has fallen off and continued to decrease at almost an increasing rate, actually. We hope that this trend continues in the new year, and it'll be really interesting to see if this continues to decrease at this rapid of a rate or if it slows down a little bit. So we look forward to monitoring this and seeing how fast the Fed can get inflation tampered down for good. Another thing I just wanted to point out really quickly about the December CPI report was just about how certain categories were hit more than others. And so here you can see the food category increased at about 0.3% month over month, which is definitely very significant. Consumers are definitely still feeling this in the grocery store and at restaurants when they eat out. Another thing I wanted to notice that the gasoline costs actually decreased about 9.4% month over to see, which categories kind of continue to fall in the new year and which ones continue to increase. So yet another week's data came out in the jobless claims and continued to emphasize the really tight labor market. So we saw for the week ending January 7th, initial claims came out at 205,000, which was about 4.7% short of the expected 215,000. And so this was also down about 1,000 from last week. Jobless claims are really one of those data points that the Fed is constantly looking at and forming their monetary policy. And so kind of between the December unemployment rate of 3.5%, which is actually the lowest since 1969, as well as these really low initial claims, the Fed might view this labor market as kind of a green light for continuing the rate hikes. And so right now markets are kind of pricing in that 25 basis point rate hike in the February 1st meeting, but who knows, maybe they're looking at these job data points and seeing that, maybe the labor market could handle a more aggressive hike. So just things to keep in mind as we kind of move throughout this year. One final economic update I just want to bring your attention to was the big bank earnings this week. So JP Morgan, Bank of America, Wells Fargo, and Citigroup all reported their earnings on Friday morning to kick off this Q4 earnings season. JP Morgan and Bank of America kind of came out on top, which is actually really interesting because you can see their stock performance has also been much better than the other two banks. So both of those banks beat their expectations by over 10%, whereas Wells Fargo and Citigroup only beat their expectations by 1 or 2%. So it'll be really interesting to see kind of which banks continue to perform really well in this higher interest rate environment, but they're also all facing higher labor costs, higher everything cost, right? So it'll be interesting to see which banks kind of pull ahead in this interest rate environment. So like I say every week here at Synergy Asset Management, we're constantly looking at the news about CPI, employment data, and earnings, and everything else you see in the economic news. So we look forward to this upcoming earnings season, and we're constantly using this data to monitor and manage each of our portfolios per their mandate. So we look forward to continuing to take great care of you guys and managing this in the new year.